AVI invest in public listed holding companies. These are companies that are primarily engaged in owning other assets or the shares of other companies. These underlying holdings have an independent realizable value because most of these assets are listed on stock exchanges and as such are priced by the market. A company may also hold unlisted underlying assets, as well as having cash, treasury shares and debt. These underlying asset values can be added together, along with cash and treasury shares. Subtracting the value of the company's debt liabilities, we arrive at the total net asset value of the company, also known as NAV. Now, as the overall entity is listed, it has a market value as well. This price, determined by the market, does not necessarily equal the net asset value of the company. When the NAV is greater than the market price, there is a discount to NAV. AVI will only ever invest in a company when the price they will pay for it is at a significant discount to NAV. When you do this, there are two ways of making money. Buying at a wide discount, even if NAV is unchanged, you can make money if the discount contracts and the share price moves closer to reflect the value of the underlying investments. AVI analyse and identify catalysts that can narrow discounts and may engage with companies to support this. Secondly, NAV growth over time, that is, strong performance of the underlying holdings, will, assuming an unchanged discount, lead to share price returns at the overall holding company level. Investing in holding companies at a significant discount to NAV is intuitively sensible, because when the discount narrows at the same time as the NAV growing, these two positive effects compound one another and produce significantly higher overall return. This can also be demonstrated on the diagram shown. Holding NAV fixed, but contracting the discount as before, we get discount return. Holding the discount fixed and growing the value of the underlying assets, we get NAV return. But, as you can see, the compound interaction of these two effects leads to a greater overall return than the sum of the parts. Of course, this is a simplification to illustrate the maths of what AVI do. Over time, NAVs and discounts continually move up and down with market prices and do not necessarily move together. AVI consistently apply the asset value investing approach across all companies they analyse. This includes holding companies, closed-end funds, and other asset-backed special situations. The team build and maintain some of the parts NAV models, which includes proprietary valuation of unlisted assets for all constituents of their investment universe. This means as market prices change, AVI can monitor NAVs and discounts to NAV for over 400 companies. From their universe, AVI then construct a concentrated portfolio comprising their best, highest conviction opportunities, where wide discounts at present are complemented by strong NAV growth prospects in the long term, as well as there being near-term events identified by AVI that should lead to discount contractions. AVI have successfully applied this unique strategy to investing for 35 years. The approach remains valid and the universe remains attractive, with significant opportunities on a global basis.